capital from a bank. Generally, you have to be in business for a while, be profitable for a while, have a pretty good balance sheet, have some collateral maybe. Mark can tell you a lot more about all the different things that you make. But it's a loan, and you pay it back by interest. At the other end of the spectrum, there's equity capital, where you sell part of your company, part of your ownership, in exchange for an influx of capital. And there you're going to pay back your investors not in any kind of debt, kind of loan repayment system. It's basically as your company either issues dividends, or if your company sells, or if it goes public, there's an exit event then for anybody that owns something in the company, including your investors. And they're generally putting money in order to get to that payout period at the end of the company's life. In between, there's another model that's emerging we might call royalty capital or revenue capital. In that model, you're basically getting an investment into your company. It could be looking kind of like debt, or it could look a little bit more like equity. But you're paying back every month a percentage of sales in order to have that capital. Generally, you're not giving up ownership in your company, but you are giving up some top-line revenue number in exchange for the investment. I think the panel up here today is going to skew a little bit more toward the equity capital side, because that's generally where we play more. And so we're going to be looking primarily at issues around raising money from investors who are putting money into your company in order to own a piece of your company, with the hope that they're going to, in the end, be able to exit out with a big chunk as a repayment in some multiple of the capital that they put in. But I want you to see that there's a spectrum of ways to raise money, and some of the things that we're going to talk about would relate to any investment raised, because you're going to have to put communications wrap it around whatever kind of money you're trying to raise. So I've been asked to do a little bit just to introduce on some of the typical terms that pertain to an equity raise. So let's start there, and then I'm going to turn it over to Michelle, and she'll talk about some do's and don'ts about things relative to raising and presenting for raising equity capital. And then Toby, who is both invested into companies and raised money for his company, will kind of talk about some of his personal experiences, and then we'll have opportunity for questions and hopefully some answers. And I think we wrap up about 1 o'clock, right? So we'll try to get done well before that from our presentation times, and have an opportunity for any questions. And along the way, please feel free to jump in. This is what we got, like 12 people, so it's like we're not even doing PowerPoint. Can you believe that? so we kind of make it discussion related. And I'm going to start off very briefly. As I mentioned earlier, we run the Mid-America Angel Network, which is a network of people who invest money into companies with an ownership stake in those companies in exchange for their money. And what we learned early on is that there are really 4 or 5 things that these investors want the company to be able to talk about during their presentation to us relative to the deal that they're offering. One is, and you'd be surprised how often companies don't know this, but how much money are you raising? It's really not a term, but it's a given. So are you raising $250,000, $500,000, $1 million? So knowing how much money it is that you're looking for is a big element. And without knowing that, you really can't put together a term sheet. Okay. A second thing that we look for is how are you going to use that money? Okay. Again, not terms so much, but just a given. So if you're raising $250,000, do you need $250,000 now, or can you tranche it in maybe 2 raises? Do you need $250,000 now, and you might need $500,000 in 6 months, and you might need $2 million in a year. So how much money do you need? How are you going to tranche that out? And what are you going to use those dollars for? Then a third thing is, what type of security are you offering? So you can offer securities basically in two types. There are multiple iterations of these, but you can either offer a common stock, which is owner's shares, so everybody plays on the same field. And whenever you sell your company, you're going to be selling common shares, right? It'd be shares that are converted into common. So, so you could have common. Oftentimes, equity investors early in a company especially want, and in fact all the way through, want to get a preferred share or a preferred unit. If you're an LLC, we call them units. If you're a C Corp or an MS, we call it a share. So a preferred unit or preferred share has certain preferences that come to the holders of that kind of unit or share. So if an investor gets a preferred unit or a preferred share, they typically are looking for things like maybe a dividend. So that's kind of an interest payment on that share, somewhere maybe between 4 and 10%, and that's negotiable. Investors are often looking for a way to curb their downside. So one way to do that is through what we call a liquidation preference. So they get their money back first before there are any other distributions in the company. So a 1x liquidation means if they put $250,000 into your company, at the exit they're going to be getting their $250,000 back before any other distributions in the company. A 2x liquidation in that model would be $500,000, or a 3x. I've seen them as high as 7x. Most early stage companies aren't going anywhere near 7x, but don't worry about that one. But you probably will see something like a 1x liquidation preference. Usually, then everybody participates on a pro rata basis in the rest of the distributions of the value of the company. Another preferred term is maybe getting a seat on the board or an observation seat. Generally, when you bring other people's money into your company, you're going to set up a board consisting of common shareholders, founders in the company, and investors, and then maybe some outsiders that you jointly agree upon, or one or the other group gets to select. And boards usually have 3 or 5 members at this stage of a company. So investors, depending on how much money they put in and what ownership stake they get in the company, often want a board seat. And then I guess one other kind of preferred, or one other preference that preferred investors will often get is the ability to have some restrictive covenants, because most of them are going to be minority shareholders. Let's say you raise $250,000, but your company is worth $1 million, so the investors own 25%. So one way they can protect themselves as a minority holder in your company is to be able to restrict the owners or the managers of the company from taking certain actions without their approval or without their vote. So, for instance, maybe you cannot raise more than X more dollars without their vote, or maybe you can't incur debt above a certain limit without, their prior approval, or you can't sell the company without their approval. So there are some things, maybe though they own less than half of the company, they can still participate in the decision process in an active way, either by thwarting or permitting certain activities.